See, I think this is the most fascinating part of the whole conversation is what you just said. Is the stepped up value, then the taxes will be, instead of 900,000 in profit, it'll only be 400,000.
Right.
Hey guys, welcome back to Daily Properties, episode number
13!
Episode number 13, and we're so excited. We have a guest on the show, our first guest ever.
A smart guest.
A very smart guest. Tom, introduce yourself.
My name's Tom Martin. My company is Martin Financial Group. I'm a certified financial planner, amongst other designations. And a lot of what I do is help people mitigate large tax bills that they have through various planning strategies.
That is awesome, and I'm going to hand the microphone over to my dad. And Dad, can you please ask the first question we have on the podcast?
Anyway, thanks Taylor. Thanks Tom. Tom's been a dear friend of mine forever. And Taylor's been I don't know, dear son, but he's a good son. But anyway, this is really fascinating because I think this is a subject that is so critical to anybody thinking about a business, a house, land, recreation, and we get to ask this all the time. And I will put money, if I don't know much about it, I'm going to be really conceited. 99% of people don't know anything about it.
That's true.
So, I mean, this is fascinating. This is something you have to think about. And Tom's been a friend of mine. Like I said, he knows his business. So, the first thing I want to get on is something where people call the stepped up structure of capital gains.
Okay.
And that's number one.
Oh, you're referring to step up in basis?
Yes.
Okay, so
And how do you tax it?
right now the way the tax code works is that if you sell a capital asset for a profit that you've held, a capital asset that you've held over a year, and you sell it for more than what you paid for it, you owe a capital gains tax. If you die holding that property and leave it to your kids, the kids' cost basis becomes the market value, so they can sell it at market value and pay no capital gains tax at all. That's what the step up in basis is.
Oh, that's
Wow,
fascinating.
that is cool. I had no idea.
Right.
Now, Tom, what is depreciation?
Depreciation is when you buy a piece of property and you've got improvements on it, buildings, anything physical. The idea is any structure over time is going to become less valuable because it's just wear and tear. So you're allowed to take a tax deduction for that loss of value as your building is getting older. However, when you go to sell the property, you're probably selling it for a profit, and all that depreciation that you've taken over the years then becomes taxable to you in what's called depreciation recapture, and that's taxed as ordinary income as opposed to capital gains.
This is all fascinating. So basically, and we talked about this earlier, just conversationally, basically everything depends on when you sell it. In other words, if you're buying this and you have a lot of outside money, and maybe you stop making that money, you will sell your property and you'll have to regain the depreciation, and you'll write depreciation off when you're making big money off your taxes, but you'll have to pay it back sometime.
Right, and it's great if you can do that in a low tax year. If you can claim your depreciation in high tax years and then reclaim it in low tax years, it's to your advantage. It doesn't always work that way, though.
So this is fascinating. So basically, is there, as far as a family structure, is there a better time to sell and not sell with a family?
Well, it depends a lot on your other non-financial goals on what makes sense to sell, when it makes sense to sell or not. The one thing what it always makes sense to sell now is we know exactly what the tax code is right now, so we can tell you exactly what your taxes are going to be if you recognize a gain this year. If you're going to recognize a gain 20 years from now, I have no idea what the tax structure is going to be like 20 years from now. Right now, I know it happens to be about the lowest we've ever seen in history, so it could be a pretty good time to pay capital gains. Good news is there's a lot of ways that we can structure the transactions to really reduce the amount of gains that we pay.
You know, and speaking of this, one more thing is they talk about like if the husband dies, the wife gets an automatic $1 million deduction or $1 million exclusion. Is that still something?
In property that's titled jointly, for instance, if I own a farm that I paid $100,000 for and I own it with my wife, and I die and the farm's worth $1 million, my wife gets a step up in basis for my share of that property. So her basis goes from 100,000 to 600,000. So then if she sells it for $1 million 2 years later, she's got a cost basis now of 600,000 and she only pays capital gains tax on 400,000.
See, I think this is the most fascinating part of the whole conversation is what you just said, is the stepped up value, then the taxes will be, instead of 900,000 in profit, it'll only be 400,000.
Right. So, I mean, if, for instance, if both of my parents are in a convalescent care center and have a year to live and they've got a $2 million farm property, I'm probably not going to want to sell that farm property while they're alive if I'm going to inherit it. I'd rather inherit that from after their death, where I get a step up in basis and don't have any capital gains tax to pay.
I mean, this is all fascinating. We're going to talk about more because, I mean, this is, we can talk about this forever because I think this is such a critical part of planning of selling a farm. I mean, I think this is, because this can make or break the whole profit of how you sell and what your tax is going to be.
Right.
Anyway, I'm going to turn it back over to Taylor.
Wow, I learned so much from that quick episode, guys, and I cannot wait to have Tom back on for the next episode. Tom, what are we going to be talking about next episode?
So in the next episode, we're going to talk about the traditional 1031 exchange, which many of your real estate investors already know about. But we're going to talk about a specific type of 1031 exchange called the Delaware Statutory Trust, which allows you to defer your gain just like a 1031 without having hands-on ownership in real estate. After that, we're going to be talking about installment sales and a special type of installment sale called the structured installment sale. And then on the final episode, we're going to talk about a way to eliminate capital gains tax entirely by using a charitable remainder trust. So stay tuned in future episodes.
Yeah, and thank you guys for watching.
It's fascinating.
Hashtag buy farms, buymoland.com. We'll see you guys next week.